$1 million. 2 investors. Same amount. Same starting year. Same finish line 10 years later. One pays almost nothing to invest it. The other pays a premium for professional management. When the decade ends, the investor who paid more is ahead by $770,000. And the moment you understand exactly why, the way you read a fund's fee will change permanently. The standard advice is clear: minimize your fees. The cheaper the fund, the more of your return stays with you. Every dollar paid in fees is a dollar that can't compound. That logic is sound. But this video runs a 10-year simulation that shows exactly when it wins, exactly when it doesn't, and more importantly, the precise mechanism behind the outcome so you can make the right call on your own money. 2 investors. $1 million each. A single fund choice. Then 10 years of silence. One buys the market while the other buys expertise. 3 questions at the end. Who made more on gross return, who lost more to fees, and when it's all settled, who has more money in their account? Let's run the test. First, let me introduce the protagonists. Meet Andrew. Meet Kate. They're twins. Same birthday. Same education. Same income. Same opportunities. The only thing they disagree on is investing. Andrew says, "I'm buying the market. I'm not paying Wall Street a fortune to do something I can do myself." Kate smiles and replies, "I'm paying the professionals. Sometimes paying for skill is cheaper than making mistakes." Andrew invests in 1 ETF. Kate invests in 1 mutual fund. Then they make a promise. No touching the money. No panic selling. No checking the news. Just walk away and come back in exactly 10 years. When they finally log back into their accounts, one of them is ahead by almost $750,000. The interesting part? The more expensive investment actually wins. How is that even possible? Let's find out. Andrew doesn't believe he can outsmart Wall Street. Instead, he buys one of the simplest investments ever created. VOO. The Vanguard S&P 500 ETF. It simply owns America's 500 largest companies. No predictions. No market timing. No superstar manager. Just the market itself. And historically, that strategy has been incredibly rewarding. Over the last 5 years, VOO has delivered an annualized return of roughly 17%, helped by the powerful rally in large-cap U.S. stocks. Looking over 10 years, it has averaged about 14.2% per year, despite recessions, inflation, interest rate hikes, and market crashes. Even better, it charges just 0.03% per year. That's about $300 annually for every $1 million invested. Meanwhile, Kate thinks differently. She believes exceptional companies can outperform the market if experienced professionals pick them. So instead of buying the index, she invests in Fidelity Contrafund, one of America's best-known actively managed mutual funds. Unlike Andrew, Kate isn't paying for the market. She's paying for expertise. Over the past 5 years, Contrafund has generated an annualized return of roughly 21%, and over the last 10 years, it has averaged around 16.4% annually. Those numbers are outstanding. But excellence isn't free. Kate pays approximately 0.74% every year as a fee. That's about $7,400 annually for every $1 million invested. Nearly 25 times Andrew's fee. So here's the question. Can a manager earn enough extra return to justify paying that much more? Let's find out. But before we jump right into the simulation, there is something important you also need to know about these funds, which is tax. When a mutual fund manager sells investments for a profit, that profit is shared with everyone in the fund. So even if you never sold a single share, you could still receive a taxable payout at the end of the year. The easiest way to understand this is to imagine you and thousands of other people own one giant fruit basket together. A professional manager looks after the basket. Every now and then, the manager sells some of the fruit that has become more valuable and replaces it with different fruit. When the manager sells that fruit for a profit, the law says that profit has to be shared among everyone who owns part of the basket. Here's what that means. You didn't ask the manager to sell anything. You didn't withdraw your money. You didn't even touch your investment. But because the fund sold something inside the basket, you receive your share of that profit. And in many countries, that profit may be taxable. ETFs usually avoid this. Most of the buying and selling happens behind the scenes in a way that doesn't trigger those payouts. In most cases, you don't pay tax until you decide to sell your ETF. If you're investing through a tax-advantaged account like a 401k or IRA, this difference doesn't really matter. That's why our comparison assumes a tax-advantaged account, to keep the comparison fair. Now let's go back to Andrew and Kate. 1 year later, Andrew opens his portfolio and here's how it looked. Remember, his initial investment was $1 million. Portfolio value after year 1 has grew to $1,142,400. Approximate cumulative fees paid is about $320. Hence, his net gain is $142,080. A fantastic first year. Here is what Kate's portfolio looks like. After year 1, her portfolio value is roughly $1,163,900. Approximate cumulative fees is $8,000. Hence, her net gain is $155,900. Even after paying almost 25 times more in fees, Kate is still ahead. Interesting. 3 years later, Andrew's portfolio is now $1.49 million. Cumulative fees paid after year 3 is $1,150. His net gain is now $490,000. Kate's portfolio is now $1.58 million. Cumulative fees paid $28,000. Her net gain at year 3 is now $552,000. Now the lead is becoming visible. 5 years later, Andrew's portfolio is approximately $1.95 million. Cumulative fees paid by the end of the 5th year is $2,500. His net gain is $950,000. Kate's portfolio is $2.14 million. Cumulative fees paid by the end of the 5th year is now $53,000. Hence, her net gain is now $1.09 million. You will notice that Andrew has paid almost nothing, while Kate has paid over $50,000. Yet somehow, Kate still has more money. 10 years later, Andrew logs in first. His screen flashes. Portfolio value is almost equal to $3.80 million. His total gain, nearly $2.80 million. And after 10 years, he has paid only around $9,000 in fund fees. That's incredibly efficient. Then Kate opens her account. Her portfolio value is $4.57 million. Total gain, nearly $3.57 million. But look at the price she paid. Over 10 years, the mutual fund has collected roughly $180,000 to $186,000 in cumulative fees, depending on how the assets grew over the decade. That's a staggering difference. Andrew paid roughly $9,000. Kate paid roughly $182,000. Yet, Kate still finishes almost $770,000 richer. The 2.2 percentage points of annual outperformance compounded over 10 years produced a return advantage of approximately $952,000, which absorbed the $182,000 fee disadvantage and left $770,000 of net advantage standing. The mutual fund won on final account value. What this simulation proves: a 2.2 percentage point annual return advantage, compounded over 10 years, more than offsets a 0.71 percentage point annual fee disadvantage. In this specific case, skill was worth paying for. The compounding penalty of fees is real, but so is the compounding power of return. Over 10 years, Kate's extra fees cost her approximately $200,000. Her extra return earned her approximately $952,000. The math was not close. The caveat this simulation cannot answer: 1. What happens in the next 10 years? Contrafund's 16.4% over the past decade reflects a specific period of technology sector dominance that drove large-cap growth outperformance. The benchmark returns going forward may look different. The manager's edge may narrow. The fund that wins the next simulation may not be the same one. This is not an argument against FCNTX. It is an argument for understanding what drives the result, so that you hold the right tool for the right reasons, not just because the backtest favored it. This is the section most comparisons skip entirely. When a fund charges 0.74% per year, it does not simply remove $7,400 from your balance and stop there. It removes $7,400 from your compounding engine, permanently. That distinction is the entire argument. A dollar diverted to fees in year one is a dollar that no longer compounds at the fund's own rate of return for every remaining year of your holding period. Let's make that concrete. Kate pays approximately $8,000 in fees in year one. At FCNTX's own 16.4% annualized return, that $8,000, if it had remained invested, would grow to roughly $32,000 by year 10. So the real cost of year one's fee is not $8,000. It is $32,000, the compounding value of what was permanently removed. Now scale that across every year of the holding period. By year 5, Kate's portfolio has grown to over $2 million. Her annual fee that year is approximately $15,000. That $15,000 compounds at 16.4% for 5 more years. Its true cost to her wealth is over $33,000. This is called the compounding penalty of fees. The percentage on the label is what you pay today. The compounding penalty is what you lose across the entire holding period. It applies to every fund, at every fee level, including Andrew's $300. The difference is scale. VOO's compounding penalty over 10 years is negligible. FCNTX's compounding penalty over 10 years is substantial. But as we saw, FCNTX's excess return is large enough to overcome that penalty. That is exactly what the simulation answered. In this case, if we are asking only one question, which one leaves more money after 10 years in this case study? The answer is the mutual fund. Would Kate still win over the next 10 years? Nobody knows. Past performance is never guaranteed. This experiment simply asks one question. If history repeated itself, what would have happened? If we ask a different question, which one is the better default tool for most average investors? The ETF still makes an extremely strong case, because it is cheaper, cleaner, more transparent, and less dependent on future manager skill. VOO's official 0.03% expense ratio is dramatically lower than FCNTX's 0.74% gross expense ratio. So the honest conclusion is this. On raw 10-year ending value in this case study, the mutual fund wins. On cost, simplicity, and predictable market exposure, the ETF remains the better default for most people. The bigger lesson is not that ETFs are bad. And it is not that mutual funds are obsolete. The lesson is that both tools can build wealth, but they do it differently. The ETF is the low-cost market machine. The mutual fund is the active bet on skill. Sometimes skill wins. Sometimes cost wins. So if $1 million landed in your account tomorrow, now you know the real question to ask. Do you want the market at the lowest cost? Or do you want to pay more for the chance to beat it? Having in mind that a higher fee fund isn't automatically a bad investment, meaning that if that fund consistently earns enough extra return to more than cover its fees, paying more can actually leave you with more money. Also take note that very few managers can keep beating the market for years. If you have a clear, evidence-based answer, paying the extra fee might be worth it. If you don't, a low-cost index fund like VOO is one of the smartest investments you can own. Because building wealth isn't about finding the perfect fund. It's about choosing an investment you understand, paying a fair price to own it, and staying invested long enough for compounding to do the heavy lifting. That is the $1 million test. Please note, past performance is not indicative of future results. This simulation uses historical data for illustrative purposes. Tax outcomes depend on individual circumstances. Consult a qualified financial advisor before making investment decisions.
Please note, this video is for educational purposes only and is not financial advice. Ensure subscribing to WealthStack so you don't miss out content like this.